Phillips Securities just stamped the $22.10 target on Venture Corporation. But beneath the tech euphoria, you are paying a premium for a stock yielding well below our absolute minimum hurdle. Institutional analysts play a momentum game, but retirement portfolios cannot afford to buy the hype and ignore the math. I have been watching the chatter around this one lately, as the market hunts for local proxies to the global semiconductor boom. The narrative driving this momentum is an artificial intelligence supercycle, with Phillips Securities upgrading Venture from an accumulate to a bull rating. The broker lifted their price target significantly to $22.10. They are pointing to the first quarter of 2026 as a critical turning point, highlighting that revenue finally returned to top-line growth after 12 consecutive quarters of painful year-on-year decline. This is the spark they believe justifies the premium. They also highlight a fortress balance sheet holding over 1 billion Singapore dollars in net cash, insulating it from the elevated rate environment. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. The broker lifted their price target significantly to $22.10. They are pointing to the first quarter of 2026 as a critical turning point, highlighting that revenue finally returned to top-line growth after 12 consecutive quarters of painful year-on-year decline. This is the spark they believe justifies the premium. And here is what sits beneath that spark. The reversal was fueled specifically by an 11.2% surge in demand for AI-related infrastructure products. This covers networking interface cards, test and measurement equipment, and semiconductor components feeding into global data centers. The broker justifies this valuation by applying a 25 times forward earnings multiple, arguing that Venture should trade closer to its US-listed peers. They also highlight a fortress balance sheet holding over 1 billion Singapore dollars in net cash, insulating it from the elevated rate environment. The load-bearing assumption holding up this entire target is that the recent top-line bump is not a temporary cyclical blip. The market is betting this is the start of a multi-year, high-margin growth supercycle driven by structural data center demand that justifies a permanent valuation rating. That is a bold thesis. To test that assumption, we need to see if the actual numbers agree by applying our 5-layer forensic audit. Running the screen, the numbers show a fortress foundation, but a critical failure on income. Gearing is pristine at roughly 0.5%. And interest coverage is easily above our 4 times floor thanks to that massive net cash position. The net debt to EBITDA metric passes comfortably as well. But the dividend yield sits at exactly 4.18%, missing our 4.7% minimum hurdle, triggering an automatic failure and pushing the stock into zone 4 caution. We also have 2 soft flags recorded for the prolonged revenue compression trend. Which brings us to valuation. The stock is currently trading at $18.44. Against an Investing Pro average fair value of $16.31. That reveals a gap of roughly 13% downside from where you are buying today. Reaching the analyst $22.10 target requires 3 compounding assumptions: a durable AI cycle, multiple expansion, and a Singapore contract manufacturer re-rating toward US software valuations. All 3 unraveling at once is exactly how retail investors end up holding the bag at the top of a hardware cycle. This is the Investing Pro data card for Venture Corporation. The platform runs 15 valuation models and lands on an average fair value of $16.31 against a market price of $18.44. That is an 11.6% downside baked into the current price before you even open the annual report. The uncertainty rating is low, which means the models are in close agreement. When 15 independent models converge on the same number, that is not a data point you dismiss because a broker has a more optimistic view. The retirement case runs into a hard wall on income. Venture is paying a dividend yield of 4.18%, which is 52 basis points short of our minimum hurdle. Even more concerning is the payout ratio hitting 101%, meaning the dividend is being funded by cash reserves, not earnings growth. When your CPF special account guarantees 4.0% with full capital protection, accepting 4.18% gives you just 18 basis points above the risk-free rate. It is like a hawker uncle dipping into his Ang Pao savings to keep the store running. The execution risk tells a story of structural compression rather than just temporary softness. Over the last 3 fiscal periods, revenue dropped from 3.02 billion to 2.53 billion Singapore dollars, and net profit followed the same staircase down from 270 million to 227 million. While the recent quarter showed a 1.9% uptick, one quarter does not reverse a 3-year trend. The company is also carrying a consumer lifestyle segment in active decline, down 12% year-on-year, with projected fourth quarter product launches as the only stated recovery catalyst. That is a hope, not a plan. The ownership signal reveals massive institutional divergence. The stock is trading at 99.5% of its 52-week high, and the relative strength index flags overbought conditions. You have Phillips Securities issuing a buy rating at $22.10, while Macquarie sits at underperform with a $10.49 target. That is a nearly $12 gap between two institutional houses covering the exact same stock. When professionals diverge this sharply, the stock is pricing narrative, not fundamentals. So who is this stock actually for? For a growth investor with a long runway and tolerance for cyclical drawdowns, the AI infrastructure thesis is coherent. A 25 times multiple may prove conservative if the data center build-out sustains, making it a legitimate institutional bet. But a retirement income investor operates under a completely different mandate. Every allocation must carry its weight in verified sustainable cash. It cannot be based on narrative, and it cannot be a piggy bank that is already being drawn down. The dividend trajectory paints a very clear picture. Revenue has fallen steadily from 3,025 million Singapore dollars in December 2023 to 2,535 million by December 2025. Net profit compressed from 270 million to 227 million over the same period. Yet the dividend per share has remained frozen at 75 cents, and that frozen commitment has forced the payout ratio up from 83% to 101%. The math behind that frozen dividend is undeniable. The payout ratio climbed above 100% not because management raised the dividend, but because earnings shrank around a fixed commitment. The interim cycle in 2025 included a modest 5-cent special dividend, which has not been repeated in 2026. The company can sustain this for now given its massive net cash position, but the mathematical ceiling is real. You simply cannot pay out more than you earn indefinitely, even with $1.285 billion in the bank. And this is where the forensic gap becomes most stark. While the analyst issues a buy rating based on AI infrastructure demand, our screen flags a zone 4 caution because the yield fails our minimum hurdle and the payout exceeds 100%. They see a $22.10 fair value focused on the FY26 to FY27 growth cycle. We see an investing pro fair value of $16.31 with a focus on retirement income sustainability. The gap is not about who is right. It is about what the stock is being asked to do in your portfolio. You are essentially paying a growth premium but receiving an income consolation prize. The analyst's logic asks you to accept a 4.18% yield today, expecting the price to run toward that $22 target. That works perfectly if you are playing for capital gains. But the retirement reality is that taking on full equity volatility for just 18 basis points above the CPF special account is not a risk premium. Do not subsidize institutional exit liquidity by buying the narrative at the top of a hardware cycle. We see an investing pro fair value of $16.31 with a focus on retirement income sustainability. The gap is not about who is right. It is about what the stock is being asked to do in your portfolio. In this market environment, the window of actionability closes extremely fast. The difference between finding a true safe haven sanctuary and falling into a yield trap is often decided in a single trading session, as institutional money moves aggressively. By the time this level of forensic analysis reaches a free subscriber on a public platform, the entry window that we initially identified has usually already opened and very often closed entirely. You cannot build a durable income portfolio by acting on delayed information in a cyclical sector. That is exactly why Iggy's elite investors get zero-day access to these forensic breakdowns the absolute moment the setup is live. When the numbers still matter, our members get the full red zone watch list and institutional-grade cheat sheets to make informed decisions. This costs just $9 a month, which is literally less than buying a kopi and kaya toast at Ruffles Place. The goal is to stop being the exit liquidity for institutional players and start being the analyst of your own portfolio. 3 things to watch. First, track the July 2026 earnings momentum. We need to see if that 1.9% first quarter uptick accelerates or if it was just a seasonal blip. Because 1 quarter of growth after 12 quarters of decline is a green shoot, not a harvest. Second, monitor the consumer lifestyle recovery, which is down 12% year-on-year. Watch if the fourth quarter product launches actually move the needle. Third, watch the special dividend signal. The 5-cent special payout from 2025 has not been repeated, and we need to see if the regular 75 cents itself comes under pressure. So what does this mean for you? If you are a 55-year-old investor structuring a portfolio for retirement, a 4.18% yield on a 101% payout ratio simply does not compensate you for the inherent sector volatility. Your CPF special account offers a guaranteed 4.0% with full capital protection. Venture offers just 18 basis points more. Always demand a proper spread when putting your hard-earned retirement capital on the line. Our closing forensic stance acknowledges what deserves respect. The balance sheet is genuinely impressive with $1.285 billion in net cash, virtually zero debt, and the dividend maintained through 3 years of revenue compression. That discipline is genuine, but the stock lands firmly in zone 4 caution. It is priced for perfection on an AI narrative that has yet to fully materialize on the bottom line. While the institutional case is a coherent growth bet for those with runway, our forensic focus is on retirement income sustainability, and that is a different mandate entirely. For income investors, this remains a strict watch and wait scenario. We stay on the sidelines until the price corrects toward the investing pro fair value of $16.31, or until management finds a way to push the yield meaningfully above our 4.7% minimum hurdle. The fortress balance sheet gives you the luxury of time, but the current market price does not. Venture Corporation sits squarely in our Zone 4 caution category. We are looking at a fundamentally strong company that is unfortunately priced for absolute perfection. The balance sheet gives you time to sit comfortably on the sidelines, but the current premium price simply does not give you the margin of safety required. We will wait for the numbers to align with our specific income mandate. Venture acts as a speculative growth holding suitable for growth investors only. For transition and drawdown suitability, we monitor and wait because while the balance sheet strength is real, the yield simply does not support retirement drawdown at current pricing. The stakes for this episode come down to separating a genuine yield foundation from a cyclical tech narrative. A yield below our hurdle wrapped in a hardware cycle is a risk profile that income portfolios must avoid. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a licensed financial advisor before committing funds.